Welcome back, everybody, to another episode of the Passive Income Lifestyle Series. I'm your host, Travis Watts, the Director of Investor Education here at Ashcroft Capital. In today's episode, what we're talking about is a reverse market crash and what it means for you. Disclaimers, as always, never financial advice. Not going to tell you or anyone what to do with your money, so please always seek licensed financial advice when it comes to your own investing. Now, with that top of mind, I will begin by saying, let's reflect a little bit on past market corrections. I think it's pretty common knowledge among all of us investors to know that markets have cycles. And the first cycle is stage one, and it's called accumulation. And this is where investors begin to jump into an asset class. They begin buying it up, and that inevitably leads to stage number two, which is the uptrend in the market. As you get more and more bidders, more and more buyers, prices tend to keep going higher, and this can actually last a series of years as markets go up. Stage number three is called distribution, and it's essentially the top of the market, and it's where the buyers get exhausted. The prices have come up so much over the previous years that the value isn't really there like it was before, so buying dies off. Stage number four is a downtrend and or a recession, and it's where prices are decreasing and we're looking to find some sort of level of normalcy, and we're seeking to find a bottom at where we're going to flatten out on pricing, which is stage number five, effectively the bottom of the market where all the selling is done. And we revert right back to stage one, which is the accumulation stage, as investors and buyers come back into the market because prices have come down, the values are back, and it makes a lot of sense to continue buying and moving forward. So where are we today in this cycle? Now, obviously, this would be subjective, and I don't have a crystal ball, and this is not financial advice, but I would argue that we're in stage four. We're starting to see a decrease in pricing, and we're teetering on the edge of a potential recession. So the question is, will we go into recession? And once again, I don't have a crystal ball, but what I can share with you is a recent study that was conducted by Deutsche Bank, and they looked at the last 34 recessions in U.S. history, and what they were seeking to find are what are the red flags that commonly lead to a recession actually happening. And they came up with 4 red flags, and I'll share those with you now. The first is a rapid rise in interest rates. So have we seen that in the last 18 to 24 months? Absolutely. The second is an inflation spike. Have we seen an inflation spike in the last 18 to 24 months? Absolutely. The third is an inverted yield curve. Have we seen this occur in the last 18 to 24 months? Absolutely. And the fourth is an oil price shock. Have we seen this recently? Absolutely. So are we going into recession? I don't know, but all 4 flags are in place right now in this country, according to Deutsche Bank. Something to think about. So most of us are familiar with how crashes have happened in the past and what's led to recessions. In simple terms, the dot-com crash of the year 2000 was rampant speculation, the stock market flying high, people gambling with money, and all of a sudden a sharp and fast reversal, and stocks and real estate crashed. 2008, the Great Recession, very similar. 2006 and 7 leading up to that, there was a lot of speculation. Stock market was flying high, real estate prices were hitting all-time highs, and all of a sudden, a sharp reversal and prices fell. The recession of 2020 with the onset of the pandemic. Stock market's flying high, and all of a sudden, it crashes in about a 1-month time frame, nearly 30%. So here we are, sitting here in Q4 of 2023, teetering on the edge of possibly the next recession. So what does that mean for you and I? Let me give you this bit of information first, okay? In the past year and a half, the Federal Reserve has increased the federal funds rate, which translates into higher interest rates and borrowing costs for consumers and for investors. And historically, that's a very negative thing for valuations in real estate and valuations in stocks and valuations in private companies. But what we've seen this time is a massive amount of resilience. In fact, the stock market, at least on the indexes, we'll take the S&P and the NASDAQ, for example, we're still positive on the year despite these massive interest rate hikes. And for single family homes, to use that as a real estate example, many markets haven't seen much of a decline, if any, and a lot of markets are actually up on a year over year basis on home prices. So let's say in an example that the Federal Reserve in the next 6 to 12 months, they cut the federal funds rate in half. Now, why would they do that? Well, a number of scenarios could unfold. The first would be we go into deep recession in the US, and they have an obligation to help stimulate and help the economy. So they're going to lower rates to do that, which historically is usually what happens in recession. Number two, we could hit their inflation target of around 2%, and then they may taper rates down from that point. Number three, our national debt is over 33 trillion in this country, and it may not be sustainable with high interest rates, so they may have to cut for reasons such as that. But in any case, we're just going to make an assumption for example purposes only that they cut the rates in half. Now, question is this actually a good thing? Let's examine the poor, the middle class, and the rich. First of all, if the Fed cut rates in half, it would actually hurt the poor for the most part. Why is that? Well, most of the poor don't actually own real estate and investments and a large portion of stocks. And so in real time, what that means is if those valuations go up, that means rent's probably going to go up. That means other consumer items are going to go up. And if you're a renter and not a homeowner, that's certainly not going to benefit somebody in that camp. Number two, the middle class. So this will be divided. Some people in the middle class will be negatively impacted while others could be positively impacted, and I'll unpack that for you. Let's say in one scenario, you've got an individual who's got a high-paying job, very little debt. They've been a renter so far. They're younger, but now they're looking to expand their family, become a homeowner. Well, if they're struggling today with being able to afford, let's say, a $600,000 home at an 8% mortgage rate, A, that would be understandable. But two, if the Fed cut rates down and then the real estate market just took off again, they might be looking now at a situation at that home costing $750,000, even though they have a 4% interest rate. So that's not really going to help that individual. And again, if someone in the case of a younger professional who's middle class doesn't have much in terms of stocks through a 401k, an IRA, or a brokerage account, there's going to be very little benefit to the market just taking off in any given year. Now, on the flip side of middle class, many middle class own homes, which that would help with building some home equity. The older middle class generations may have a lot more in the stock market, in which case that would help their 401ks, IRAs, and brokerage accounts. So this category really just depends. Some will get squeezed and some may benefit. So that leads us to the wealthy, and I will also throw in this category investors. Now, this would actually positively benefit the rich, the wealthy, and investors. Why is that? Well, that's because the wealthy own assets, they own stocks, they own real estate. In fact, according to CNBC, the top 10% of wealthiest American households now own almost 89% of the US stock market. So if valuations go up, their existing portfolio goes up, their new investments go up, their real estate goes up, and this only widens the gap between the rich and the poor, while the middle class gets squeezed, and while some will fall to the bottom and a few will rise to the top. So in summary, a reverse market crash is where you see prices rapidly begin to rise, but very few people actually benefit from that economic situation. So the question is, do you want to be part of the select few who do benefit from that price action? Not just talking about the rich and the wealthy, but also talking about investors that are willing to take on some risk, be opportunistic, dollar cost average, and invest through volatility. If you'd like to learn more about our current offerings and opportunities, you can visit ashcroftcapital.com. And once again, I'm Travis Watts. You can reach me at travis@ashcroftcapital.com if you have any questions or want to take a deeper dive on this subject or any others here on the channel. You're listening to the Passive Income Lifestyle. I hope there was some value for you in this short episode. Please like, share, and subscribe. Share these episodes with anyone you think could find value. Until the next episode, have a great week, everyone. Truly appreciate you being here.